Hello, everyone. Welcome to another Tax Tip Tuesday. My name is Rose Brown, also known as the Accountant Therapist. And this week we are talking about filing statuses and how they impact you on your taxes. Now, this is one of those things where a lot of people don't truly understand. So I'm just here to break it all the way down for you. Before I jump into anything further, I do want to make this grand announcement, as if many of you have not yet heard, but tax season actually started yesterday. What that means is the IRS started accepting electronically filed income tax returns for individuals. So if you have not already started, gathering yourself, taking inventory of what you did in 2024, now is a great time to do so. And in fact, last week's live was talking about getting ready for tax season. So if you have not watched it, definitely go ahead and give it a peek because there are some incredibly important things that was discussed last week. And also, if you haven't already hopped on our website to gather some of our resources, which is the checklist for individuals and businesses, definitely check it out because what you want to do is, as you're filing your tax return, you want to make sure that you've taken inventory of everything. Because the last thing you want to do is file a tax return that you have to amend and then boom, the IRS sends you a notice and now you're faced with additional issues. You don't want issues from the IRS. So ultimately, get ready for tax season. That was last week's video. Tax season started yesterday, so you want to make sure that you can begin to gather yourself. And of course, we have a little bit of time, April 15th, so make sure you go ahead and gather yourself. With that being said, today, as I mentioned, we're talking about filing statuses and its impact on your tax return. And a lot of people have questions as it pertains to what should I put as my filing status or can I claim myself? All these interesting theories, right? So we're going to jump into that. But before I get there, I am the CEO of Brown's Advisory and Accounting Firm, where we provide an array of accounting services, including taxes, right, for individuals and businesses. And if you would like to reach out to us, you can do so through our website at www.brownssca.com, or you can send us an email at info@brownsaaf.com. And I'll go ahead and put that information in the comment section so that you can have it for your records. So let's jump into it because oftentimes as I talk about taxes, I get so excited and I want to make sure that I cover everything that we're going to talk about today. So ultimately, let's talk about what a filing status is. Now, your filing status pretty much determines your filing requirements. And in doing so, it helps to determine your tax bracket, right? It helps to determine whether you're eligible for certain credits or deduction, or pretty much that filing status takes it all away from you, right? And it also determines your default standard deduction. And I do want to define what a standard deduction is before I go any further. So, your standard deduction is what is issued or allowed to individuals who are filing an income tax return. Now, these are US residents, meaning you are filing a Form 1040. You are issued this default standard deduction. So, everyone gets this regardless. Of what's happening, right? However, you will have the opportunity or the ability to choose between the standard deduction and the itemized deduction. I'll touch on the itemized deduction a lot more later on, but ultimately, because the filing status is so closely related to the standard deduction, I'm going to talk about those in pairs, right? So the standard deduction, it's a default amount that is issued to each filing status. They're different based on the filing status. And that's what we're going to kind of get into today. And I'll give you the amounts. And I do want to go ahead and begin to share my screen because there's a lot of important stuff that I don't want to speak and you don't get to write it down if that's the case. Okay. So ultimately, there are five filing statuses. You can either file as single, head of household, married filing joint, married filing separate, or qualifying widow or widower. Okay. I sometimes can't pronounce that too well. Nevertheless, I'm going to jump into the single aspect, right? So typically, this is when it's just you. You're unmarried, you're legally separated as of 12/31 of the prior year. This also says, hey, I don't have any dependent. And the standard deduction here, remember I mentioned standard deduction before, allows you to have access to this $14,600. Now, with filing single, just because you live by yourself and you kind of take care of yourself, that doesn't make you a dependent, right? You actually have to be taking care of someone else outside of yourself that ultimately, for the most part, resides under the same roof that you're in. So single is usually the most straightforward filing status, right? So it's just you, nobody else, no dependent. You're just going ahead doing your thing, right? Now, when we talk about head of household, that adds a little bit more complexity to it, right? In this situation here, you're typically unmarried or considered unmarried as of 1231. Right. And that could look a little bit different. So when you're going to file your tax return, if you had a pretty interesting year in 2024. For example, divorce, you got married, or you just had some interesting stuff going on. Definitely make sure that you're bringing that to your tax professional's attention so that you get the right or really the appropriate filing status for you. Okay. All right. Now, with claiming the head of household status, you have to ensure that there's a dependent on there, right? So you can't be the only person on the tax return. There has to be a dependent. That dependent could be your child, it could be a relative, it could be a parent, but ultimately it needs to be someone that you are providing more than 50% of their living needs for, and you're taking care of the upkeep of the home, right? So you're doing so in a capacity of more than 50%. Now, there are situations where your child may have not been living with you for the whole year because they were away at college. That's an exception. That's fine. Ultimately, you're still caring for that child, right? If it's your parent that lives with you, even if they get retirement, those sorts of things, as long as you are caring for them, you're providing more than 50% of their living needs. Okay. And when we say upkeep of the home, we're talking about rent, mortgage interest, we're talking about food, utilities, those sorts of things, right? So you want to make sure that you're doing an assessment there. And then, of course, for the standard deduction, it's a lot higher than if you were single because, of course, you're caring for someone. They're kind of keeping this in mind. That is $21,900. Okay. Now, with regards to the next filing status, I'm going to jump into married filing joint. Now, married filing joint is one of those filing statuses that a lot of people love because it gives you more. For some reason, gives you access to more. But ultimately, you would be considered legally married. So you're legally married as of 12/31, 2024, and you guys are filing a joint income tax return, right? And even if your spouse passed away during the year, you can still do a married filing joint return. Ultimately, within this filing status here, everything is shared, right? So the liability is shared, the refund is shared, everything is shared for the most part, unless there is an innocent spouse or an injured spouse. And again, if you had an interesting situation last year with regards to you and your spouse, but you still want to file jointly, make sure you speak with your tax professional to determine how you can best safeguard yourself and not be exposed to something that you may be unaware of, right? Now, the married filing joint standard deduction is the highest deduction, and that is $29,200. So you can imagine that's a lot, right? So this is one of those things where if you're married filing joint, it gives you access to a lot more benefits, right? And filing jointly oftentimes gives you access to a higher tax bracket, so you're not at the same as other filing statuses. Okay. Now, with married filing separate, this one's a little interesting, and it's oftentimes discouraged to go this route because of the benefits that are taken away from you, right? But ultimately, when you are married filing separate, it's it's a situation where you would be either married but choosing to be filing separately due to circumstances, right? Or you're just filing separately because you want a lower tax liability, or you're just seeking to just file independently from your spouse. Now, I see this a lot of times, and I try to counsel clients through it as well because when you do marriage filing separate, you're taking into consideration just yourself, right? And in taking into consideration only your activities, a lot of what you may want is not made available to you anymore. Okay. But again, there is another side to where, hey, you know what? I have student loan, and if we file a joint return, it's going to show higher income and they're going to want to take higher payments from me, or I have child support or something that's going to garnish my refund. So the situation may be a little bit different. That determines whether or not you want to do married filing separate. Okay. However, this is not a favorable filing status because it tends to exclude taxpayers from taking advantage of certain tax credits and deductions offered by the IRS in some states. right? So that an example of that really is the education credits, right? And child independent care credit. If you file married filing separate, you're not eligible to claim these particular credits here. And in addition to that, you can take the earned income tax credit unless you have a qualifying child and you're meeting certain other requirements. So you can see here, it's almost as though they're saying, hey, you know what, you want to do married filing separate? Go ahead and do it. You're just not going to be in a favorable position pretty much. Right. And another disadvantage to doing married filing separate is for a person who has a rental property, right? Whenever you have a rental property and you have a loss on it, most times you're able to take advantage of that, right? However, if you're doing married filing separate and you have a loss on that rental property, you're not able to take advantage of that loss, which is really unfortunate for a lot of people. They end up carrying the loss forward and forward until they're able to use it, but not in the current time that they're filing separately. Now, again, as I mentioned, one of the upsides of doing married filing separate is if you want to avoid sharing financial burdens with your spouse. Again, that could be student loan, maybe you have a debt somewhere and you just don't want them to be impacted by it, or you yourself don't want to be impacted by it. Okay. Now, the standard deduction here is 14,600. Similar, it's the exact same thing as a single because you're considered to be single pretty much from a standard deduction perspective, but else all other areas of it, you're not. Okay. And then the last filing status here is this qualifying widow or widower, or some refer to it as surviving spouse. Right. Now, this status here is pretty unique. It's whenever someone was married, but their spouse became deceased and you have a child that you're supporting at home. Right. Now, in utilizing this particular filing status here, you also have the ability to claim it for the next 2 years after the prior year that your spouse passed away. Okay. And with that being said, because it shares similarity with the married filing joint, it's the same standard deduction amount, right? So that's $29,200, which is, of course, of the highest. Now, the next thing that I want us to keep in mind is just a few additional things, right? If you are blind or over the age of 65, you do receive an additional deduction to your already existing standard deduction. So as you can see here, if you're head of household or single, it's an additional $1,950. And this is a situation where it's as of 12/31 of the prior year. Okay. And if you're married, filing joint or your qualifying surviving spouse, that's $1,550. Okay. Now, as we as I mentioned earlier in this conversation, the itemized deduction, it's important to note and understand really how it works, right? How they relate to each other, the standard deduction versus the itemized deduction. Now, when you're filing your tax return, you have the option to choose only one. And of course, you always want to go with the one that is going to be most beneficial. The standard deduction under the current tax code is pretty high in comparison to what it was before. Therefore, a lot of folks are now using the standard deduction, because the itemized deduction, you literally have to do so much in order to get over that standard deduction, right? So again, if you're single, the standard deduction is 14,600. That means if you want to use the itemized deduction, all your expenses that you're itemizing has to go over that 14,600, which could take some people a while. So just to explain what the itemized deduction is. An itemized deduction, they're qualifying expenses that you have not been reimbursed for, that you've paid out of your pocket, right? And I've listed a few examples here. So that's your mortgage interest, right? Whenever you pay your mortgage payments, there is interest associated with it. You get the option to you have the ability to claim the deduction associated with the interest. And of course, we have state and local taxes, your charitable contributions, if you have medical and dental expenses, that again, these are unreimbursed. No one's reimbursed you for these things. And maybe you had a casualty or theft associated with your home. And a lot of folks, I know in 2024, I mean, hurricanes after hurricane, it was just Last year was a crazy year for casualties of homes. So if you're one of those people, this may be the deduction for you, the itemized deduction, right? Now, in terms of charitable contribution, I like to touch on that because a lot of folks in the past, they'll give to nonprofit organization and they're like, yes, I'm going to bring this to my accountant and we're going to write it off. Sorry to break the bad news. With a charitable contribution, unless you're given a lot and in addition to your other types of itemized deduction, it will be obsolete for tax purposes and it will just be more so given from your heart, if you will, right? So let me just give you an example. And I wish I did an example on this here for you, but ultimately, if you gave charitable contributions of $5,000 and your state and local taxes were $4,000, we're up to 9,000, and your mortgage interest was 2,000, now we're up to 11,000. So you have 11,000 on the itemized, and then you have 14,600 on the standard deduction. Think about it. Which one would you go with? Of course, you want to go with the higher one. Of course, it also breaks your heart that you spent all this money and you're not able to do anything with it because, again, under the current tax code, the standard deduction is just so high. Right, so you just want to make sure if you are planning on using the itemized deduction, it is something you want to be very strategic about, right? So if you're going to give, and you want to give with the intention of having a tax write-off, hey, you want to be strategic about that. You want to make sure that you're given to a 501c3, a tax-exempt organization. Your mortgage interest, maybe you want to pay up on your mortgage so you can front load a lot of that interest to hop onto your tax return for the year in which you want to use the itemized deduction. Again, if you do want to use itemized deduction, be strategic because the standard deduction is so high. So imagine being married, filing joint, and it's 29,200. You know, for some people, it won't take them long to jump over that hurdle. But again, it's still a lot of expenses to get up to that 29,200. So for a lot of people, they just accept that the standard deduction is as high as it is. Now, if you are in a situation where your filing status is not as straightforward as a lot of other people, the IRS do have a quiz on their website, right, at irs.gov, where you can go and just take the quiz if you are unsure, or again, just speak with your tax professional, let them know your situation, and at that point, they should be able to say, hey, based on what you've told me, this is what I'm recommending that you do, right? So that concludes today's live. I know it was a lot, but for me, it was exciting. If you have any questions, I'm always available. You can comment, you can send me a messenger, wherever you want to contact me. You can reach out to me through our website at www.brownsfca.com. Again, email info@brownsaaf.com. Again, my name is Rose Brown, also known as the accountant therapist. And today we took care of the filing status, its impact, what it is, how it works, and what you should be keeping in mind as you proceed with filing your tax return for 2024 in this 2025 tax year. Again, I will see you next week for another amazing topic. And if you have a topic that you want me to kind of break down so that the general public could have a better understanding, I'm really open to those. I love teaching.